So it's currently November 29th, Cyber Monday, and the S&P 500 is up 0.86%, and the QQQ is up 1.51%, and the VIX, or the Volatility and Fear Index, is down 13%, although if we zoom out to just the past 5 days, it's still up about 30%. Now, for those of you that's been living under a rock, the reason behind all these intense price movements is because of the Omicron variant. So the Omicron variant appears to be more highly transmissible than the Delta variant, and due to that, the WHO has categorized this as a variant of concern, but this is the positive news. There's no evidence yet to suggest that it is more deadly than the Delta variant. And this potentially very low mortality rate is why people are calling the sell-off on Friday an overreaction, because we're seeing articles like this that say the South African doctor who first spotted the COVID Omicron variant says the symptoms seem mild so far. COVID symptoms linked to the new Omicron variant have been described as extremely mild. It actually started with a male patient who's around the age of 33, and he said to me that he's just been extremely tired for the past few days, and he's got these body aches and pains with a bit of a headache. The patient didn't have a sore throat, but more of a scratchy throat, but no cough or loss of taste or smell. So that's the major piece of news that's causing this nice rebound in the market. If we look at the crypto markets, we're also seeing a strong resurgence here as well. Bitcoin is up 5.65% in the past 24 hours, and Ethereum's up over 7%. Taking a closer look at Ethereum, this is the sell-off that happened when the news first broke of this new variant, but the price action has already almost fully recovered, which is a great sign. And here's some additional really positive news on the matter. So Moderna thinks it may be able to develop a new COVID vaccine to fight the Omicron variant by early 2022. They're quoted as saying, if we need to make a brand new vaccine, I think that's going to be early 2022. So that's some very positive news, because the major thing fueling the sell-off on Friday was the rumors that this new variant could evade immune protection. That's still unknown, but even if that is the case, a brand new vaccine can be ready in just a few months. Now, we do have some negative news, but I think the positive news does far outweigh this. But Anthony Fauci told Face the Nation on Sunday that the US has the potential to go into a fifth wave of the pandemic. So that's the bad news. We might be going into a new wave fueled by the extra transmissibility of this variant, although the mortality rate seems to be very low with mild symptoms caused by this virus, and a new vaccine, if need be, can be ready in just a few months. Alright, so that's the situation. Now, the question every investor is asking themselves is how can they prepare for any eventuality? So this article is claiming that a correction of around 8 to 9% still looks probable, and if that is the case, he's arguing that a growth ETF like SPYG is going to be better than the S&P 500. And of course, the main reason for this is because of the sizable assets in IT, consumer discretionary, and communication services, and these are all sectors that did pretty well in 2020. Now, to expand upon this idea of using growth and stay-at-home technology as a hedge against a potential new variant, the ARK Innovation Fund has to be one of the best destinations for this, because in 2020, this had a rally of over 200%. And they, of course, invest in a lot of the innovative technology stocks that did pretty well in 2020. So names like Tesla, Teladoc, Unity Software, Coinbase, Roku, Zoom Video Communications, Shopify for e-commerce, Spotify for music streaming. So if this is the approach you want to take, it could be a potential good buy-in time, because even today, this ETF is still down 0.35%. Over the past 5 days, it's down almost 6%. Over the past 6 months, it's down 4%. And year to date, it's down 14%. So the ARK Innovation ETF has definitely not rebounded yet, and thus is trading at a relatively cheap valuation. And I would say definitely has the potential to move higher, especially if this virus becomes a problem again. Now, as mentioned in my last video, my hedge against potential volatility in the market is to use dividends and covered call strategies. So in terms of dividends, we all know the data that during market recessions and just volatile markets overall, continued dividend payments hold up significantly better than price appreciation. So they act as a great base of return. And the second part of my strategy is covered calls found in ETFs like XYLD. And the reason why I view them as a hedge during volatile periods in the market is because, again, much like dividends, they provide a base level of return when price appreciation might be lacking. And also, in addition to that, the premiums collected by selling covered calls is directly tied to the VIX index, or the volatility level of the market. And if you look at them side by side, the VIX and the S&P 500 have an inverse relationship between them. So as the market goes down, the volatility goes up, and the premiums collected by selling covered calls also tends to increase. So in my portfolio, covered calls not only give me a base level of return, but during volatile times in the market, they have the potential to give me even more returns. So utilizing covered calls is one of my favorite hedges in the markets, but another option you have is to use inverse equity ETFs. The benefits of inverse ETFs have to do with the alternative ways of placing bearish bets, because not everybody has trading or brokerage accounts that allow them to short sell assets. And if I come back to my portfolio, that's also why I use ETFs for my covered calls, because one, they automate the process, but second, M1 Finance, my brokerage, doesn't yet have the ability to manually sell covered calls. So if you think the market has more downside to go, these inverse ETFs could be a great way to make that bet. But keep in mind, a lot of these have leverage, so we can see that SQQQ has 3 times leverage. Now, long term, these are awful investments because generally the market tends to go up over time, but the use case for these products is very specific. If you think the market's going to go down, these could be a good way to make that bet. But I have to say, so far, based off of the news and the data that we have on the new variant, I just think the odds of going through another 2020 style correction is very slim at this point. But as mentioned, if we do go through that situation, in my portfolio, the way I hedge against this is through dividends and covered calls. That's going to do it for this video. If you guys are still watching and enjoyed the update, let me know by leaving the video a like and subscribe to the channel because it helps me out a lot and it's greatly appreciated. But I'll see you guys in the next one.